Hello, hello. Welcome back from lunch. I hope that you're caffeinated enough. Now, I would like to welcome Mark Richardson, Head of Research at Bancor, for an amazing keynote. Mark, the floor is yours.
Good afternoon, Crypto Valley. So for those who haven't met me yet, my name is Mark Richardson. I am the product architect and the head of research at Bancor. And so one of the things that that I'm trying to achieve with this presentation is to sort of give you the most general sort of overview of what it is that our new product release actually is, the kind of value proposition that it gives to users, but also to the industry. And so for those who were at my masterclass yesterday, that was very sort of down in the weeds, understanding very specific sort of mathematical components of AMMs and how they operate and that kind of thing. But this is more sort of, for the generalist audience. But if there's anything that I mention in this presentation that sort of arouses your curiosity and that you would like to explore in more depth with me, we have a booth outside, and I'm very happy to go into as much detail as you like. So the title of this presentation is that it's a new day for DeFi. And this is because we really think that the last 12 months, really everything since DeFi summer, right, which is even further back than that, we've seen a very large number of different DeFi protocols being invented and tested. I think that we've been through this amazing sort of epoch in sort of economic experimentation, if I can put it that way. I think that of the economic models that have been tried and tested, the majority of them have happened in DeFi over our recent history. But I want to come back to sort of fundamentals a little bit, because a lot of people have been asking me, like, what was the, where did Bancor come from? Why does Bancor exist? People seem to know that we were the first DeFi protocol, or at least the first AMM, not just on Ethereum, but anywhere. And I think that this quote from Aesop, which is that those who voluntarily put power into the hands of a tyrant must not wonder if it at last be turned against themselves. This is really I think the most concise way that I can communicate the inspiration behind what Bancor is. Just over lunch, I had a really lovely meeting with the team members from Kiln, and we were speaking about what is it even going to look like in the future, right? Do I expect that AMMs are going to annex the entirety of finance, right? Do I think that every single market in the world can be made using an AMM? And I do. But I don't necessarily think or want that to happen. I consider these things to be in equilibrium with each other. I don't trust private market makers, and I don't think anyone should, because they are motivated, of course, by their own self-interest. They are profit motivated. And I don't think it's controversial to point out that some of the private market makers in cryptocurrency have made more money than any other private market maker in any other market anywhere in the world over that period of time. And that value has to come from somewhere, right? And if it's not exploitative, it can at least be predatory. If they are extracting that value, it has to be from markets and therefore from market participants. That opportunity is fine, and I don't mind it being there, and I don't mind them using it. But the problem is the lack of an alternative, right? As long as they are continually being able to siphon that kind of value off of market participants without anything standing in the way of it, then of course, if you let that run to its logical conclusion, we end up with an essentially exploitative system. And Bancor was invented to take some of that power away. So we have a history of inventing the future, I would say, or at least reimagining the future of finance. We had our ICO in 2017. We established the Bancor Foundation in Switzerland, in Zug, with those ICO funds, and the Bancor Foundation continues to support the development of the protocol, but also support for the whole industry. Many people may not know this, but Bancor actually predates Ethereum and smart contracts and DeFi by quite a way. We were the first to experiment on a large scale, I think, with community currency projects. So in places like Africa and even some places in the United States, we were looking at whether or not it's even a good idea to have the government-issued fiat as the sole way to communicate value between different market participants. And so that system works quite well, by the way. But when it has to interface with outside economies, the problem becomes exchange, right? If you have a community currency that you're using to buy, for example, labor, maybe someone mowing your lawn or painting your house, how does that translate into a US dollar valuation to buy things like gasoline or other commodities within that contained economy? And it doesn't. And so we invented AMMs because you want a way to establish that valuation process for a currency, any currency, to know its value in a reliable and a decentralized way without having to have that valuation at the whims of an emotional market maker, someone who is prone to panic, or someone who is incentivized by their own profit motive to value something a certain way and then force the market to just accept that valuation. So AMMs, in our case, were invented exclusively to address this problem that we saw with community currencies, and then realizing that it's actually a general problem that doesn't just affect all of cryptocurrency, but maybe every asset in the world. So in 2017, we actually launched the first AMM, and back then it was an entirely regulated operation, right? DeFi didn't really have a name for itself yet. Ideas like permissionless use of things, and anonymous use of these products was still to come, right? That narrative hadn't really began. And so, unlike many of the DeFi projects around today, Bancor is intimately familiar with regulation. We have a very strong relationship with both MME and FINMA. And we are collaborating with regulators and lawmakers to make sure that DeFi progresses in the most reasonable way. When, after we launched the AMM, we had an opportunity to observe how some of those design principles affected the people that are interacting with it. So in contrast to centralized market makers that understand precisely what they're doing, you can't actually make that assumption about DeFi users necessarily. People that are providing liquidity out of their own volition may not understand that what they're participating in is something like a self-financing trading strategy. And the experience back then, as we established it, was that if you have a token such as a Chainlink token, which is Link, and you could then pair that with any asset. For our protocol, it was BNT, but the status quo in Ethereum right now is to pair it with Ethereum itself. When you provide both of these tokens together, it's the AMM itself, the protocol that you're using, that is prescribing your portfolio for you. So you're actually forced, if you're an AMM participant, to combine these assets in a known ratio to that curve, okay? And I think that is problematic. One, because and I know I'm intimately familiar with the Chainlink community. In general, they don't like holding any other token except for Chainlink, okay? And there are other DeFi communities where they want the maximum possible exposure to a particular token because either they believe that it's going to outperform the rest of the market, or they have a very deep-seated loyalty to that particular token, and they refuse to sell it. This can also be a bootstrapping problem. If you are a new cryptocurrency in the space and you want to create a decentralized liquid market because you don't have the resources or the relationships to establish an operation with a market maker, then you have to do this stuff yourself. And if you are selling a very large amount of your token before it's liquid in order to make markets with it, then you're actually driving its price into the ground at the first, before you even get legs under it. So this forced token exposure in DeFi is a problem, but not just through bootstrapping, but also because of this kind of leakiness of value that we call impermanent loss. Now, I introduced this into my masterclass yesterday, and so if you'd like to know more about how to do this calculation, I suggest that you look back over that recording. But essentially, when you are providing liquidity to an AMM, you are sort of short the price valuation and long the fees that it generates. And because of the profound volatility of some tokens, this assumption might last for a long period of time, and you can be net positive. But then eventually, if one of those tokens halves in price, or if one of them goes 10x in price or something, you actually might be better off not providing liquidity at all and just hodling the tokens in your wallet. The problem with that is that once users start realizing that they're always better off holding the tokens and not participating in these kinds of DeFi products, then it's actually eroding away that kind of decentralization security that we were looking at, where we are trying to take back some of that stability, right, and trying to establish an organic price discovery mechanism for cryptocurrencies and community currencies. This impermanent loss issue cannot be understated. We created a website called il.wtf where you can put in your Ethereum wallet and it will measure how much money you've lost by providing liquidity on our competing protocols. And you can see some of these numbers are not insignificant. There is someone here that's lost $2,103, there's $51,467, $14,000, and these are regular DeFi users. One of the tiles there was for in excess of $1 million lost due to liquidity provision, and that's a problem, right? We cannot. If my accusation against the private market makers of the world is that they are siphoning value from naive market participants, then how is this system any better? Right? If we are asking users to provide decentralized liquidity because it's good for the market, because it's better for the ecosystem, but that they're losing value in the process, then I am a hypocrite. And I think that that's a problem. So Bancor version 2 sought to address both of these problems, right? Prescribing a portfolio for a user cannot be something that we force, and forcing users to take on this impermanent loss risk is also a problem. So with Bancor version 2, we discovered a way that you can still use the underlying AMM design, but split tokens up so that you can take as much exposure to one token as you want, even if it's 100% one token. So if you're a Link Marine and you only want to trade, if you only want to hold Link and you want all of your portfolio exposure in Link, you're welcome to do that. And if you want your portfolio to be distributed in any way that you want to compose it, Bancor can support you, and you can provide liquidity with it at the same time. We're the only DEX that still allows you to do that. We also invented the concept of impermanent loss protection. This is a condom. We have some at the booth, by the way, if anyone wants to come pick up some of our marketing materials. One of my favorite charts right now is how many condoms you can take through customs versus how suspicious that is. Something like 50 to 100 condoms is like really suspicious, but like 2,000 condoms and they don't even bat an eye. But we think that this is important, one, because DEX and sex rhyme, and so practicing safe DEX is just something that rolls off of the tongue. But I think that it helps to instill this idea that there is a risk, right? Like DeFi can be fun, but it's also dangerous. And so, inventing products that protect people from sort of these, these problematic consequences is something that I think is not controversial. And this is kind of just the lighthearted way of addressing it. So those two things, single token exposure, should you want it, or any amount of portfolio composition possibilities, and protection from a permanent loss, is something that we've already done. Right, our new product is building on these concepts, but they were already achieved long before Bancor version 3. So we just recently, a few weeks ago, launched our new version. And there are some really, really significant changes in the system, not all of them of which I'm going to be able to describe today in terms of things like the way that smart contracts are organized and the type of new possibilities that it gives you. And I'm not even going to be able to talk about everything that Bancor 3 is intended to be. Because of how ambitious our goals are with this release, we've actually been forced to split it up into 3 different small releases. And so I'm only going to talk today about phase 1, which is what we're currently in. If anyone goes to the app and sees that there's only a few tokens, for example, just be reminded that we are still deploying the contracts. And so we're sort of in this slow release mode. The protocol isn't 100% ready, but you can definitely see it sort of starting to roll out of the gate. The first feature I want to talk about is instant and permanent loss protection. I said in Bancor version 2, we had already developed this insurance mechanism. For those that are more financially privy in our audience, one of the ways that you can understand the cost of impermanent loss on an AMM is by considering it to be essentially an American perpetual option. And you can use things like volatility metrics to compute what the value of that option is over time. And so using data prior to the launch of Bancor version 2.1, we sort of established that during the first 30 days of liquidity provision, based on data from 2017 to 2018, we can't insure you. So during that first 30 days, you can withdraw whenever you want, but whatever the impermanent loss is, you have to wear it. After that 30-day period, you kind of jump up a cliff to a 30% vesting rate, and then you kind of accumulate 1 extra percent per day of insurance coverage up to 100 days. And so this is a point of friction, right? From a product perspective, it's problematic. But from a financial perspective, it made a lot of sense, right? This really agreed with our risk assessment at the time. But the data from 2017 and 2018 is horrifically out of date, right? Cryptocurrency is maturing. Things aren't as volatile as they were. I know that the past couple of weeks, that doesn't seem to be true, but I promise you it is, right? The whole market is kind of finding this stable equilibrium. It will always be volatile, but nothing like what it was back when we were first developing this mechanism. And so on revision, using more recent market history, we've actually learned that it's possible to create a system where you don't need this vesting period at all. So in Bancor version 3, you are protected from impermanent loss from the first instant that you provide it, with the one caveat that you have to give 7 days notice when you withdraw. That's it. So moving back from a 100-day vesting period to a 7-day effective vesting period, I think is a pretty significant improvement. That's a 93% reduction in the time that it takes for your insurance to vest. And I'm really proud that we've managed to build that out into our new release. So this, we're calling this safe staking. You'll see that a lot in our marketing materials. And it's not just that vesting period that's improved. The withdrawal algorithm that actually handles the liability of the protocol during that withdrawal, it massively improves the cost efficiency. And we've also added support for other token projects to offer to cover the IL themselves. Remember I spoke about this bootstrapping problem, where you have to sell a large amount of your token in order to establish initial liquidity. This is only true if you're providing both sides. On Bancor version 2.1, and this continues into Bancor version 3, the protocol offers to bootstrap 50% of the pool for you. So there is no initial sell pressure that sacrifices your token valuation as you're establishing liquidity. And this has made us extremely attractive to the high-quality token projects in the rest of Ethereum. We've currently accepted, I think, 35 different DAO treasuries into the Bancor ecosystem, and this is continuing to improve. And these are established DAOs. If you're a new DAO, the insurance risk of the impermanent loss of your token is relatively unknown. And so one of the ways that you can help to offset that risk and encourage the Bancor DAO to support your token is to offer to cover the IL yourself. Because this insurance, this insurance fund is not a part of the circulating supply. It's akin to being in a Gnosis safe with a type of slow release schedule. In terms of optics, this also helps the team because they can say that some of those tokens are still locked and aren't available to contribute to selling pressure. So in terms of everything impermanent loss related, Bancor version 3 is a lot more sophisticated, a lot more stable, a lot more risk off. We've also developed a product that we're calling the Omnipool, and this is kind of relating to the way that the smart contracts are organized. But one of the consequences I'm going to explore with you right now. In Bancor version 2.1, we still had discrete liquidity pools. So essentially baskets of different assets that are kind of combined with BNT tokens. And because BNT is in both of those baskets, you know that the ratio between those two assets are whatever it is in BNT. And that means you know what the ratio is between either asset that isn't paired with BNT. And I'll show you what this means. If someone's performing a swap between ETH and Chainlink, you can first perform a trade to BNT on one pool, and then perform a trade to the other pool. And because every asset on Bancor is paired with BNT, it is the universal numeraire, and this means that any token is exchangeable for any other token. The problem is that you have these two hops. For any smart contract engineers in the audience, you'll know that this will mean that there's two different token send requests a part of that transaction. And so there's kind of an unnecessary gas consumption to the way that the network is arranged. So with Bancor version 3, rather than picture everything as being separate buckets, we've kind of visualized this as more like a BNT central component, a nucleus, with the tokens orbiting around it. And this isn't just a heuristic. The actual Bancor version 3 contracts are in a single vault with BNT, and that means that everything has a relationship to VNT where it currently is. So you no longer have to send tokens between different liquidity pools. The trader can just send a token into the vault and have the vault send that token back. So rearranging this animation, if someone was to want to swap ETH for Link as they did before, from the trader's perspective, the ETH is just sent into the vault and the Link is sent back out. So we actually managed to eliminate a whole token send transaction in the middle, and that means that you get a lot more gas efficiency out of the system. So we call this a one-hop trade, whereas the other one is a two-hop trade. Now, that gas efficiency means that we can start to use we can start to build in other features into the protocol that would have been gas prohibitive before. So with that gas budget that you now have, you can now start to build in other features such as security features, right? Things that make people worried in DeFi, things like price manipulation attacks, right? Things like flash loan attacks. And the system that we've built, and I'm going to come back to this later in the slide, is generic enough that it's actually appropriate for deployment anywhere. It's not specific to EVM, and that kind of generalization actually hasn't been achieved by any project except us. The other thing that we've developed is the Infinity Pool. Now, Infinity Pool, again, is a marketing term, but I can describe exactly what it means. On Bancor version 2.1, because it's an insurance protocol, we can't accept arbitrary amounts of capital, right? Can you imagine if someone tried to provide, I don't know, $1 trillion worth of Ethereum, that we would then be on the hook for $1 trillion worth of IL potentially, maybe more. So Bancor version 2.1 had a specific cap. You cannot provide more than X liquidity, and the DAO pre-approves that liquidity. And that meant that one, as a DeFi protocol, you're kind of nailing your foot to the floor in terms of TVL. This is obviously a KPI that the rest of the industry cares about, but we couldn't take on that risk, right? It's not enough that marketing is better because you've got more TVL. The actual functioning of the protocol has to be put first. In Bancor 3, though, with the Infinity Pool design, we've actually found a way that we can accept an arbitrary amount of capital, an infinite amount of capital, without affecting necessarily the insurance liability of the protocol. And so this means that we can accept a very, very large amount of liquidity, and the overall risk to the protocol remains constant. This is pretty profound. For our Bancor version 3 release, which is still in a soft launch, we only have like 3 tokens, and I think the TVL at one point was already over 500 million. Whereas with 150 tokens on Bancor version 2.1, I think the maximum that we got to was 2 billion. And so if you scale that, right, or if we're expecting that to scale, the TVL of Bancor version 3 could be absolutely breathtaking, something akin to something like Aave. The other advantage that you get here is you further decentralize the number of people that are providing liquidity, right? One of the problems with capping pools is that you have fewer liquidity providers, and that, again, goes against some of the advantages of AMMs that I espoused at the beginning of this presentation. So it's not just a bigger TVL of the protocol, but also a more decentralized community of liquidity providers, and I think both of these things are equally important. The auto compounding rewards is something that I have spoken about at Permissionless, if anyone saw me there, and that's a recording that I have online. And I'm going to show you just briefly one of the user-facing features for this, and if anyone is interested in how this is beneficial to the industry, please find me after the presentation. But essentially, one of the ways that DeFi use has been incentivized is through liquidity mining rewards. And how this works is you would contribute your capital to a liquidity pool, and then the token contract would issue additional tokens, essentially for providing that service. Now, on any other protocol except Bancor, that would mean that someone would have to sell off like a proportion of those tokens in order to buy another token to provide more liquidity with it. But on Bancor, you can just provide the tokens as is. But it's still a new transaction, right? That's still gas costs. And on Ethereum, gas costs can be a controversial topic. In Bancor version 3, the auto compounding rewards just require you to provide liquidity once, and without any other transactions, those incentives just accumulate on your position over time. This also, by the way, has a significant tax relief benefit, because every time that people were claiming those external rewards from a contract and it was getting added to their wallet, it generally triggers a taxable event. But with the auto-compounding rewards of Bancor version 3, and this is again is an institutional-facing feature, because that value is accumulating just on the pool token itself, it's akin to capital gains, which is only triggered at the time that you actually dispose of the token. So from a tax perspective, it's a lot more efficient, and from a user perspective, it's a lot less friction because it's less clicky, right? It's less contract interactions. This is generalizable. So we're doing this both for the BNT community, but we're also allowing external token teams to do it themselves. So you can be a liquidity provider both in BNT and TKN. So let's pretend, I don't know, Chainlink providing their own rewards. And both of those positions could auto-compound. And so again, this is happening in a way that you only have a single token in your wallet, and that token valuation is simply appreciating over time because its pro rata share of the liquidity of the protocol is increasing. And so there's no claim, there's no trying to bid up the gas price or anything like that. This is all happening behind the scenes, so it's much more cost efficient for users. Bancor has only ever been on Ethereum. Okay, and I still think that Ethereum is the only blockchain that I really trust to last forever. Maybe Bitcoin as well. But this needs to change. We need to be more pragmatic. And there are a lot of really great options, and our community is always investigating which one of those is likely to be the thing that best serves Bancor's mission. What I want to point out here is that it's usually the case that when projects are moving from Ethereum to another chain, and I consider all L2s to be other chains, that it has to be something that is EVM compatible. For Bancor, that's absolutely not necessary. The way that the contracts are designed, the security modules being, for example, time independent, means that we can deal with essentially any blockchain architecture. If we want to use Cairo, for example, on Starknet, or if we want to use Rust on Solana, anything, if we want to use Substrate on Polkadot, any of these blockchains are appropriate, and they won't affect the way that the contracts work. Of course, we will need to change the actual programming language, but the actual internal logic that allows the protocol to do what it does is completely unaffected. And again, this is something that very, very few protocols have ever done, and I think that we're the first AMM to realize that generalization and genericness is actually a huge competitive advantage when you're dealing with a multi-chain ecosystem. So Bancor version 3 has these features, right? The auto-compounding rewards, and again, there's an industry-facing utility to this that I'm happy to describe if you want to come and talk to me after the presentation. The instant and permanent loss protection, with the only caveat there's a 7-day cooldown. The Omnipool architecture, which has massive gas efficiency that allows us to better spend the gas economy in order to improve the security of the system. The dual-sided rewards, which means that you can do this on both BNT and any token, so long as that token team supports it. The genericness of the contracts and the design, which means we can go to any chain and have the same confidence that we do on Ethereum. And the fact that we can accept unlimited liquidity, meaning that we can grow our community and grow the TVL of the protocol. There is one other feature, which is that to migrate from version 2.1 to version 3, after all the pools are supported, will only require a single click. There's no withdraw, restake, or anything like that. We've got a contract that does it for you. And that contract has the added benefit that you can actually migrate from any protocol to Bancor version 3. So right out of the gates, we support migration from Uniswap v2, SushiSwap, so that if you are experiencing IL on those platforms and you're kind of sick, right, of taking that risk, there will be an option on the Bancor website to say migrate my Uniswap position, migrate my SushiSwap position. And so I think that this is kind of the friendliest type of vampire attack that I think the industry has seen. But I actually think that it's in the greater interest of the community, right? I don't feel like we are attacking these other protocols, but supporting the users of those protocols. It's a slightly different sentiment. And I want to remind you that I've spoken about some stuff that I hope you agree is actually pretty exciting. And it's just the first phase. In a way, this is the stuff that we get for free with the new contract architecture. The real ambition is what you can do with those contracts once they're established, and this is going to take me some time, right? Not all of this stuff is specced out, but the roadmap, at least internally, and where we know that Bancor has to go, and where we know DeFi has to go, where we know cryptocurrency and blockchain has to go, is kind of well understood. And I think that we have a unique claim to erudition to that because we were also the first here. No one pays attention like we do. And so I hope that you've enjoyed that presentation. This is, a really exciting time for us. Again, if you go to the app, please be reminded that the rest of the system is coming in the next few days. But I really hope that you see what it is that we're trying to do and why it's valuable. And if there's anything that I can do to address any questions that you have, I'm happy to take them after the talk. Thank you so much for your attention.
Thank you, Mark. This was amazing, and thank you so much for giving us so much insight into this new dawn. We're excited about it.